All right, what a day today. We continued that selling from last week into Monday today. Big move to the downside. There's a lot of really good signs out there. As bad as it seems, there's a lot of really good signs. In fact, we remember these days, right? We remember March of '09. We remember May of 2010. We remember August of 2011, August of 2015, February of 2018, October and December of 2018. Remember these big dates, these big moves that ultimately were low points, but extreme moves at the time. Well, March of '09 is probably going to be that again. So we're going to remember early March of '09 as a significant low point for the markets for a lot of different reasons. I'm going to show the reasons why today, as well as what trade idea, in case it isn't. In case we have more downside, our trade idea has got a good opportunity for some reward on its own, regardless of what the market does. So let's go ahead and get started. Today is Monday, March the 9th, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the Market Forecast Indicator, and you can see breaking below this low point that we had, the last intermediate low point. So we are now having a lower intermediate low. We did talk about the potential for this divergence. That's kind of what we were expecting, was a lower low to form right around 280, 275 on that Bollinger Band chart. In fact, it was this Bollinger Band chart here, not the daily chart, but the not the 1 year chart, but the 5 year chart. Right about this 280 to 285, 275. There's a big volume node here, and so far it's acted as a support. If we break below that, though, there's the next support levels all the way down here to 210. So we don't want to break through this volume node. It's a pretty big area, so it's not an individual spot, and that's where the top of the value area is. So most of the volume over the past 5 years is between 273 down to 181. So we kind of need to stay up above this and get going again. And once you clear this 300 area, it'll be easier on this long-term basis to get going. Obviously, on more of an intermediate basis, we're going to have to clear a lot higher than that, probably up to 3270 before we really feel confident about moving to the upside again. 300 would be kind of in this spot right here, and that's not going to be enough. That's definitely not going to be enough. It's not even, again, to get a green, dark green shading in a green line, it's going to take a long time because we're that far below the 30-day moving average. In fact, if you look at the crossover here and you look at how far away we are below the 30-day moving average, and change this PPO here, just to kind of give you an idea, we're pretty far. 30-day moving average. There we go. So in fact, I've got to move the line down further because we fell lower, even though we're off the low of the day. And this is the 40 and 50-day moving average. We ended up down 13%, 13.17% below the 30-day moving average. So to kind of give you an idea of how significant that is. And let's go back 20 years on SPY. So there's where we're at, the blue line. So we didn't get that far below in December the 24th. We only got the 10% below, roughly. We didn't get that far below in January of 18. Those are some more recent, really bearish times. We only got 6% below there. So we doubled that. You can see on some of these others in August of 2015, when the Chinese currency was devalued, we fell 9% below the 30-day moving average, and that was it. If you take a look, during that whole bullish period, we didn't fall hardly below at all. And then we had this bear market of 2011, and 12.5% was the low point. And that ended up being the low. That ended up being very similar to what we're seeing right now, where it was a Friday. This was on Friday. We got really far below the 200-day moving average. That's the blue line. And then the red line was the Monday after. Very similar here. Big down day of the Monday after. That's at the low, though. We bounced right off of it, came back down, bounced right off, came back down, bounced back up to the 50-day moving average, came back down, went below it a little bit before rallying immediately in 3 days, back up, got above the 200-day moving average, and kind of coiled here and then broke out. So no failure there. So I mean that was the lowest we got. At that kind of set the low point for a while and was immediately followed by a big move to the upside. We're already up 2% in the overnight trading, which is not a good thing actually. We want this, so you can see how we opened up right where we closed. You don't want to open up higher. That means there's a lot of bullish trading overnight and on really light volume. We want all the bullish volume to be during the regular trading. We want all the bullish mood to be during the regular trading session because that's where all the volume is, and that's what helps it stick. Right? It doesn't stick very well overnight. So. But you can see again, you go back out, here's 2011, March 2011. There is another period of bearishness in 2010, and the worst we got there was 7.5% below. So now you come out here all the way to 2008. We got down to 19% below, and that was again the end of a bear market. A lot of this really looks very similar, and this is when the bear market actually started. When we got the death cross in January of 08, we got only 7.5% below. So again, this isn't how bear markets start. These kind of moves is not how bear markets start. That's the big confusion for a lot of people, and because we're coming off of all-time highs. This isn't the type of move that starts bear markets. It didn't start it in 2007, 2008. Right, that's where that bear market started. Here's 2000. See, we didn't have a big 13% move below the moving average that started us on this death cross right over here. We got 7.25% before when we dropped below the 200-day, and then we came up and failed and then moved down. Right, so here we are, 13% below. That's the kind of move that we've seen finish bear markets, right? We had the 2008, October 2008, obviously, and then you come over here to, this is where the SARS was, but really the worst of the worst that it got down to in 2002 was July 2002. We did fall almost 14% below the 30-day moving average. We really fell off a cliff at that point. But then that set the low point. You can see we came up to the 50, we retested the low, we came back up to the 200-day, we formed a higher low, and then we ended up going. So that move set the low point, just like it did in 2008, right? So right in here, right, we got to a divergent low point there. We got to another divergent low point there in March of 09. But that pretty much set the low point here. A little bit of a head and shoulders, and then we just kind of had that last little dip. But again, this is the kind of move that finishes bear markets, not that starts bear markets. So that's why, and you'll see here in a second too, another thing that really has stood out to me is the zigzag. I tweeted out, I wanted to point this out too. If you were to take the zigzag here, and instead of doing 1%, do 20%. Like our 20% moves from, see, we're not down 20%. And if you notice, we are down, let's go back, maximum available, as far back as we can. So we are down to 62% to the bottom of, this is the bottom of the retracement area, the market sentiment run. This is one big market sentiment run where the market sentiment line's gone above 50, and now it's going to eventually come back below 50. But then there's the high. Notice how we got up 400% exactly off of that this Christmas Eve low point. But that's where the market sentiment run started, and now we've retraced all the way to the bottom of the support zone. This is the 38 to 62 is your Fibonacci retracement support zone. So we're hitting some pretty good support here at less than 20%. That's significant because if you notice here, when you get these, see, that wasn't a 20% move. In fact, let me show you here. Let me switch this. I'm going to switch this to 14%. It was close. It was a 19.78%. So that one didn't get to 20% below the moving average. And we had that drop right there, and it didn't even get to 14% below the moving average. But remember, that was above the 200-day moving average. This got below the 200-day moving average. Here's the next time we got below the 200-day moving average and had a death cross. We only got 14% below. So you can see why I picked that number, at 14%. Then we didn't have another. This is our last set. This is 2011. In 2011, we also didn't get 20% below. We got close. We got 19% below, and then that led to a 93% rally. Right, and this 19% drop led to a 44% rally. That 14% drop there led to a 60% rally. We had this 16% drop in 2010, May of 2010. It wasn't 20%. That started QE2. That led to a 33% rally. And then of course there's your bear market. Again, you notice the bear markets. It also didn't start with a big huge drop. We were down at this point. We were only down 18.5%. So there was a good chance there that we could just stayed bullish. But it failed here at the 200-day moving average. And once it failed and we dropped below 20% there, now we're at 20%. Good chance that we're going to roll over. So the failure was a big red flag, and then that 20% was that final nail in the coffin that we were going to go into a bear market. In this bullish run here, you notice we didn't have a single drop of 14%. We had a 95% run, almost 100% run off of the 2003 low point. That's where, again, that's where the low point was set, and then we kind of got that inverted head and shoulders pattern, and then that started the bullish run there. So again, you look over here to see when this bear market started, and once we got down, so here's the the low. This is the highest close. We got down 10%. We got down here 13%. So everything was fine. Even here, you were down 17%. But at this point, we're below the 200-day moving average. We came up, we failed, and once we got down 20%, more than 20% below here, then we were done. And then we failed again. This would have been in May of 2001, and then things really hit the fan, of course, and with 9/11, and then 2002 was really bad. So, but again, you can see no 15% run. This wasn't in 98. As bad as that was, it was not a 20% drop. It was really bad. Not a 20% drop. That led to a 60% rally. Again, that whole time in the mid 90s, where we had the mid-cycle adjustment right here. We had another kind of emergency cut there in 98. All the way back to 90 was the last time we had, and again, not a 20% drop from all-time highs. And of course, that led to a 300% rally in the mid 90s. Then you go back before that, and this was 87. Of course, that was Black Monday. We fell 33% there, and then that led, you can see it led to a 64% rally there. 14% drop in the early 80s and 84 led to a 127% rally. So the point I'm trying to make is we're down 18% off of that highs. We've been down this far before. We've been down this to support before. We haven't. This doesn't necessarily mean. In fact, you can see the retracement. This is where the market sentiment rally started there, and then the market sentiment ended up here. So it was right up in there, and you can see it got just barely below the 62, enough to, the day before it was fine. Then it broke down, and then the next day popped right back up. So fake out. Kind of a fake out support break. So we might do that tomorrow, but we'll see. Especially since we're gapping, as of right now, we'd be gapping up tomorrow. But you can see how that support held too, and we bounced right off of it and kept going up. So that's kind of what I'm expecting here. People are saying, we're going to go into recession. Well, just so you know, like a 20% drop in a week amount of time. Like the market doesn't have more to price in for recession. We've pretty much gone all the way back to where we were in early 2019, and then again in June of 2016. And if you recall, earnings growth has already been on a steep decline since right here. This is when earnings growth in the S&P 500 on a year-over-year basis has been. In fact, we've been really close to negative. We just barely popped back above zero. In the last quarter, in Q4 of last year, on a year-over-year basis. So the idea being is that this is the typical move that ends bear markets, not necessarily starts one. And then we have been in a decline. We have been in an earnings decline, an economic growth decline. In terms of growth rates, not necessarily like negative numbers, but in terms of growth rates, since October of 18. If you recall, that's when inflation expectations peaked and dropped. I showed you that on Friday. And of course, all the international areas peaked earlier, and they led the way lower. So, another sign that we might have already been in a bear market. And just because the FANG stocks led the S&P higher doesn't mean that we haven't already been in a bear market, in a recession, and this is the end of one. So we'll see. We'll see if that ends up being the case, but a lot of signs point that way. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. Also hit the thumbs up icon that's down below the video. That lets us know two things. Number one, you liked our video today. Number two, you want us to do it again tomorrow. Quick way to give us feedback. You can do that right now while you're watching. Also, comment, what did you get out of the video today? What did you like about it? You know, as you're listening here to the rest of it, or anything you've already heard, comment on what stood out to you and what you liked about it. Why you think other people should check it out. Join our website at marketscholars.com. There's a link right there in the top right corner of your screen. Click on that link to subscribe for free to our site. Follow me on Twitter for more content between the videos from day to day. And join our Facebook group, our Market Outlook Facebook group that we've created. All right, if you're watching this on our website, we also invite you to check out our Market Outlook Live trade review videos. That's over here on the right. Just click on that button. It takes you to our live video. You can also click on it right by mousing over Market Outlook, clicking on Market Outlook Live Trade Review. You can see our upcoming classes. You get access to all of our classes and our Market Outlook Live videos with our monthly subscription. There's a link right above the video here that will give you some more information on that, as well as you can see the difference between our monthly and our premium subscription levels by clicking on pricing, the word pricing there. Also engage with us on social media. You can click this heart. That will like today's Market Outlook tweet here. Click this thumbs up. You can go and like today's Market Outlook Facebook post. Again, the more you engage with us, the more those platforms will promote our content in your timelines. So then make sure that, because they promote content that you engage with the most, we try to make it very easy for you here. All right, so of course you can still see like the divergence. I mean, there's a big time near-term divergence setting up here, intermediate divergence, and close to another cluster on the S&P 500. Of course, the Russell 2000 did get another cluster. So with the divergence also setting up on that too, big drop in the downside in the Russell. And again, I mean, very, very far away from that 30-day moving average. So setting up similar to 2011, setting up for big moves to the upside, up to the top of this, to the bottom of that gap there. We'll see if that tomorrow, as early as tomorrow. So we'll see if that ends up playing out tomorrow. Let's take a look at the long-term chart. You can see the PPO is still above zero, so we still don't have a death cross yet. And if you look at the candle, I mean, we're obviously below the 200-day moving average. We're at that 62% support level. So there is some support in this area. You know, again, we're not going to get back above the 200-day moving average this week, or probably next week. So we're going to be in death cross, right? We're going to have a death cross. The question is that the low point like we've seen at other times? Have we set the low? Are we going to end up with a long lower shadow this week to where we might not finish above the 200-day, but if we finish up towards that 38% level, towards 3,000, and we end up with a lower shadow, like this whole candle, today's candle ends up being a long lower shadow on the weekly chart, like we see on some of these others when we set these lows, these kind of long lower shadows here. So we'll see if that ends up being the case by the time all is said and done. But again, it's going to be a couple of. We're not going to V bottom here. When we get death crosses, even if this is the bottom and we retest it multiple times, it's still going to be like a matter of like a couple of months before we finally get the dark green shading and the green line again. If you take a look at, in fact, you'll probably get 3 green arrows or you'll get 2 green arrows at least before. You've got a little bit of a inverted hammer pattern here along upper shadow today, opening and closing where we ended up opening. You can see the divergence on the stochastics. You also have some big divergences showing up on the RSI and the CCI too. So lots of divergences, and these are extreme lows. That's an extreme. To get below 20, we don't get below 20 on the RSI very often. In fact, if you look here, there's the only other times were right here at the beginning of that move, and then at the end of it, and then over here in August of 2015, we got down below 20 on the RSI, and then again August of 2011, we got down below 20. So it kind of gives you an idea of just how extreme it is to get not just below 30, which is bearish in and of itself, but to get all the way below 30 and to set up this divergence. It's a very positive development on these oscillators. But you go back to the MACD, you can see the MACD is not, but you are on the histogram. you're getting the opportunity for a divergence pattern. When you get this extreme lows, it's, more often than not, it's better to get divergences on the actual MACD itself. But a lot of times you don't get that on you don't get the divergences on the line more like you would on the stochastics or these other oscillators. You end up getting it on the histogram. Here you got it actually on both the histogram and the actual MACD line itself. And if I go back to 2011, here's your histogram, and then again your lower low here with the higher low in the histogram and the line. Again, that took weeks to play itself out. So we'll see. It's going to take a while for us to play out this extreme low on that. And so I showed you this is the MACD. Remember, MACD is based on absolute value, so it's going to be bigger numbers to begin with. The PPO shows again that we are very extreme. This is a very extreme low. It's hard to sustain, especially even just on an 8-day average. It's hard to sustain that kind of level. And if you take a look at the intraday chart here, and you can see, again, very, very wide range. You got the low tag again on the far left. Remember, it doesn't stay over here very often. So again, another sign that will pop back up here. You tend to get it and then pop. You get it and you hit it and then you pop. Especially when you're this low. We're 16 points. Sorry, math is apparently hard for me. That's about 40 down to 27, so about 65-ish points. That's way more than 10% of the high. Way more. That's going on like 15% of the high. It's an extreme stretch of the rubber band. And again, when you stretch it, it pops back sharper. And so look for a move up into at least 290 to fill in that gap, if not all the way up to 300 to fill in that gap before we retest these lows again. If not, go a little bit lower. But there's very, very strong support in this area on that 5-year volume profile. If you look at today's volume and trading range, it's another extreme day, especially if you include obviously only 10 points, but if you include the gap, so we close at 297.46 and the high of 284.19. So let's say 284.76 would be 13 more points. So there'd be a 13-point gap plus the 10-point range. So you're looking at an extreme gap. That's the biggest one that we've had. Biggest gap, if we include the overnight trading, that's the biggest gap we've had so far. Not the biggest amount of volume. We had 385 there, but still pretty significant. The second biggest, 300 volume. So again, that's just shows that we're spiking here now. We're easily above 3%. We're spiking here on the volume as well, and you can see the trading range. So it's again it's setting up for a big move up in the short term. It's setting up for a big move up, but that doesn't mean that we're going to start trending higher. It just means that we're going to get back up towards like that 8-day moving average before coming back down to these levels, like we saw over here where we popped up and we came right back down to a divergent low point like we were talking about before. So, but look, once we stop getting, and I showed you this before too, you get these big down moves. These big down moves are typically followed by big up moves. So, which means we're going to have big down moves again, especially with the VIX where it's at. We're going to have big down moves again, and that's going to be followed by big up moves again. And so, and we saw again you can see where historical volatility is, just to kind of give you an idea of how volatile we are right now on a historical level, right? So, I'm going to get rid of. I'm going to get rid of this one, and I'm going to move this up so you can see this. So the blue line, when was the last time we've had the blue line this high? Well, it was 2011, and here's where we set the low point, and then here's, we were just a little bit, the volatility kept going up really high. We had very, very big moves back then. The VIX is higher now. The VIX is higher now than it was then, but this is where the historical volatility got high. So this isn't unprecedented. We've seen this before. It was in August of 2011, and of course at the end of 2008 it got really bad. This is things really hit the fan here. The VIX got way higher than where we're at right now, and the historical volatility got way high too. And then again here in March of 2009, same thing. Before that, you notice historical volatility got really high again at the end of 2002 when we set the low point, right? And then we had a couple lows and then finally got going there. But we set that low point in at the end of 2002. So there's that. And then right here, historical volatility got this high in 98 during the that real bad decline, the long-term capital management there. Thai baht collapse in 1998. And you can see we don't get a lot. Right, here's 87. This is Black Monday in 1987. And then you can see, like, I'm in the 60s now, and the volatility doesn't get this high as we are right now. We did a little bit here in 62, but that kind of shows you just how bullish we are. At 46, we had this much volatility and moves that were this big. If you take a look at what was going on in 46, well, I won't let you see it here, but you get the idea. I don't know if it will. Maybe if I need to do, let's see if it will let me. No, it's not. You can't really see it, but you can kind of see the big decline that we had at that point. We went from 18 down to 14. Big decline on a percentage basis. So anyway, you get the idea that this is a significant move, and it's, how much more downside do we have? It's hard to have a lot of downside when we've stretched the rubber band out as far as we have. To the point where we haven't had very many moves like this, and every one that we've had typically have led to bounces. I tweeted out a few things today that said if we don't get a 2% gain tomorrow, it'll be the first time ever on a 5% drop on a Monday. And we've had a lot of 5% drops on Mondays. Mondays are the bad days, just like we saw in August of 11. When we're below the 200-day moving averages, Mondays can be a really bad thing. All right, so let's take a look at the VIX then and then see how bad the VIX has gotten here. We're still right around the 125% mark. Death cross territory, of course, so we're expecting a death cross. 54, second highest print behind that, the 2008 print, higher than the 2011 print that we had on the VIX. So very, very high VIX. Just to kind of give you an idea again of what happens when the VIX is this high. We've had a lot of days where we have open candles here. We haven't had very many red candles, but let me just show you. Let me go back to that 2011 time frame here. So right here, 2011. So there's 2000, right? That's 2010. There's your May of 2010 where we got up to 44 and got a pretty decent print there on a relative basis. But here's 2011. So we got all those open candles, but look at all the red that we had since. A couple quick spots, but lots of red candles since, which means the volatility goes down more than it goes up. We've had a big run. This is where we're at right now. And now expect volatility to work its way down. But it's going to take a while now because we're so far up. It's going to take a while in this bearish territory. It's finally going to break into the neutral zone. It's finally going to break through the neutral zone, and that's when you get bullish down here. So there we go. All right. So to summarize, it's been an explosive and extreme and very singular, rare type of move, but not a move that we haven't seen before. We've seen this type of move before, different story, different reasons why for the drop, but we've also seen what happens after. So that's going to drive our expectations going forward from here. There's a lot of support in this area. We might break it on one day and get a little bit of a fake out, but a very good chance that we pop up very sharply around these levels before retesting again multiple times. So expect us to get back down to today's lows multiple times, or around today's lows. Maybe not right exactly on it. Seen this story before. It's extreme, it's crazy, but it's not unique in terms of we've never had it. We've had it. We can go back to the other times where we've seen it, and even to the fact where we have a big down Monday after a bad week. We've seen this before. So we'll drive our expectations will be based on that, and that starts off with potentially a big move to the upside tomorrow. Hopefully not just overnight. If most of this move is overnight, then expect this probably to go down to a lower low tomorrow, because you like to have your big moves during the regular trading session, but not overnight. So we'll see if this holds overnight. You prefer to open around the close, if not a little bit lower even than today's close. That would be the better open tomorrow, because then you can rally throughout the day with a lot of volume, instead of rallying overnight on very extreme volume. So what do you think? Do you agree with that? Do you disagree? There's a link popping out right there on the top right corner of your screen. Click on that link. It opens up a poll. Hit either agree or disagree. If you click disagree, comment down below as to why. What are you seeing that would suggest either that you think the bottom's falling out now, as if it hasn't already, or do you think that this is going to be a V bottom? It's not going to take a couple of months. It's going to go up immediately. Let me know in the comment section below what's driving that opinion, what charts you're looking at, what indicators are telling you to have that different posture. All right, now let's talk about what's some of the other intermarket relationships here. And of course, if you thought we had a blowout move on TLT on Friday, boy howdy, did we have a blowout move today on TLT. Not as much volume, but you can see, look how far up above we opened the second standard deviation level. Fell all the way back down to it, which is normal. Normal for that type of move, of course, when you get that far away from it. That's on the 1 year chart. That's on the 5-year linear regression. Very, very extreme. Here's the 10-year, again, very extreme move to the upside. And then, of course, the 20-year, let's look at it on a weekly basis here. The 20-year also opened up way up above. And actually, no, this is going to say that's a weekly volume. If you take a look at the daily volume here, so go back to the 1 year chart, you can see, and again, not as much volume as what we saw. 1 year. Well, not as much volume as what we saw, but still a pretty extreme amount of volume. So pretty big, extreme move, very, very overbought. Again, that's a sign of an end of a bear market. Again, if I go back, you can't go back because I don't think this was around. It was around 2007, 2008. So there's 2008. This is December of 2008. You see the big extreme move it made in December of 2008. It only goes back to July of 2002. So if I were to do, so I can't go back 20 years, but if I just go to July of 2002 to December 31st of 2008, to kind of give you an idea of just how extreme, again, that move was. That's how, as another time, over a long-term basis, we got out 2 standard deviations away. Again, the end of a bear market, not the beginning of one. We never did get an extreme move at the beginning. Here's the beginning of 08. That's when we got the death cross. We were bullish, but we weren't extreme. Not nearly to the extent now where we're getting the death cross now. Right? Again, very similar to what it looks like then. If you take a look at gold prices, actually let's go to the gold contract. There is, let's see, this is a 1 year chart. There's gold. If you look at it on a 5-year basis, again, a very extreme move on gold. Like if I were to go back as far back as I can on gold, you can see gold actually peaked in early 2008. We had a big move to the upside in gold, and then gold actually fell by the time things really hit the fan in 2008. So, and then we really rallied with the weakness in the dollar in 2011. Again, August of 2011, another period where gold kind of hit extremes, like we are, at least right on a 5-year chart, right as we are right now. You can see on a 10-year, we're also towards the top end, of this linear regression trend line over the last 10 years, 2 standard deviations away. So very extreme moves. And then, of course, the flip side of that coin, and the reason why we're so bullish or bearish, is the dollar index. You can see the dollar index has been rolling over. It's broken down, and it's gotten to its lowest level it's been for about a year. If you take a look at its market forecast chart, You can see here on the daily chart we're dark pink shading and red line, we're really falling over. If you take a look at this weekly, you can see we're just barely getting dark pink shading and a red line and breaking through these lows. So very significant breakdown in fact, we'll see this is a very similar pattern for our trade idea of the day. Similar to it's looking like it's breaking down here. And if I were to go to the death cross chart for the dollar, you can see how far below the 200-day moving average we are. So again, we're headed to we're getting a death cross on the dollar here. And when we get death cross moves on the dollar, just like I said before, that it's not bullish for equities to get a bullish move on the dollar like we did. That's not a good sign, and it's played out to where we've been really bearish. So like I said that before, I'll say it again. When we are bearish, when we get these bearish moves on the dollar, if I were to go to SPX, especially since we're not really extremely bullish on the dollar, like extreme highs like we were back then. But you can see here, when we're pink, when we got the pink line shadings here, look how bullish the S&P gets. Look how bullish the S&P got there. It started to get bearish in 2008, and when the dollar was hitting extreme lows. So that was an extreme. You can see all these other bullish moves that occur during bearish times on the dollar, and I'm expecting another bearish run like this coming out of this on the dollar, and that tends to be bullish. So it's a good sign for us. It's bearish when the dollar is rising, and another sign that from January 2018 we probably should have been more bearish. And if it wasn't for this really decent strength in the dollar, we probably would have been more bearish. But we've been in the bear market. We've been in the bear market according to other risk asset classes, according to sector rotation. Again, if you go to that sector rotation, according to the sector rotation, we've been in the bear. I mean, this is since January of 2018. The S&P is now down 3% from that January high. Look at XLE down 56%, financials down 25%, materials down 20 some odd percent, industrials down 17.5%. These are your cyclical areas. Again, these are your FANG stocks up here with your safety havens. You have real estate and utilities and staples all up here, but your FANG stocks, XLK especially, really bullish, and that is what's kept us from being bearish. That's what's kept the S&P up. Remember, the technology is big weighting in the S&P. Energy, obviously, very small weighting in the S&P. So that's what's kept the black line up. Otherwise, we would have been a lot more bearish than this. In fact, if you look at the different foreign markets here, so it'd be this one, and go back on this to that same January 26th of 2018 time frame. Look at all these 20s and 30s% from that January high point, and the S&P is only down 3% because of the dollar strength, but also because of the FANG stocks have really kept us up. We've been in the bear market. If the S&P were down here, you would think that we've been in the bear market, and we have. Like, risk appetite has been in the bear market. You look at the asset class comparison chart here, and you go back to January 26th of 18 again. In fact, this is actually, you have to go back to October of 18 right here, because that's when the lagging commodity prices hit. Commodity prices, they peak last, right? But equities peaked here in January. You had a little bit of a peak there, but then commodities peaked. But I mean, this is bear market. Look at these equities. Small caps down 18%. Crude oil down 50%. That's bear market. Risk appetite has been in the bear market. The type of move we're seeing is indicative of the end of a bear market, not the beginning of one. And the fact that it's less than 20% so far means there's a good chance that we're not going to get a extended multi-year death cross bear market. We're going to get a pullback to this low point support, and more likely we'll hammer around here for a couple of months before rolling back up. And when we roll back up, we have an opportunity for a pretty decent run to the upside because of how overbought the safety trade is and how oversold the risk trade is. So for our trade idea of the day, I wanted to take a look at a McDonald's. McDonald's looks very similar to the S&P 500, except for on the weekly chart, you can see it's kind of breaking down below these old lows and giving us dark pink shading and red line. If you take a look at the Bollinger Bands, for McDonald's, and you look at it on this chart, you can see how we're breaking below the point of control, as well as breaking below these lows. And if you look at the Ichimoku cloud for McDonald's, you can see that not only we're breaking below it on the one daily chart, but also on the weekly chart, we're getting below. So very significant kind of support break for McDonald's here. Now, who knows if it's going to go down or go up. But there's a good chance that it does go down. If you take a look at the trade, again, we've already put this on. But if we buy the 170 put, sell the 165 put, that keeps my risk to hardly anything here. We're going to keep it at $1,000 because there's a very good chance with that support right here, essentially, that if it breaks up to the upside, I can keep my risk to at least half of that, if not a third of that. And that's where my tweet comes in, that we were already up 100 at the time I tweeted. We were already up $100. We're only up 68 now, but we were up $100 at one point. I tweeted that out for about $300 of risk. So about a third of my risk I was already up in a matter of 15 minutes. And again, if it goes down to 165, which is well within this area, if we continue to break down because it's broken support, similar to what we saw in RCL, then we'll get a $4,000 reward for that $300 to $500 of risk that we're taking. And that's the kind of moves we need to get. When the market's breaking down, we need a good reward for the risk. And the market bounces back up and bounces back up a lot, then we need a very, very small risk, very small loss for that big reward that we can get. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link right there in the top right corner of your screen that takes you to our Market Outlook forums. Comments, open up any new threads, any questions or comments on today's video, and let's keep this conversation going in our community. Reply to other people's threads, and let's talk about it. What are you seeing? What are you thinking right now? And let's keep this conversation going. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit the comment section, or hit the thumbs up down below, comment on our video, follow me on Twitter for more in between the videos, and I put a lot out there today, so make sure you follow me there for more, and then join our community at marketscholars.com like I showed you earlier, as well as our Facebook group. Have a great rest of your Monday night, everybody, and we'll see you all tomorrow.